Morning everybody, welcome to this weekly general update for the 24th and 25th of September, and certainly the last 2 days in overseas global markets, Thursday night and Friday night, have seen some very substantial moves that are pretty much in the direction that, or they're exactly in the direction that I anticipated, because that's the way the patterns were playing out. But the abruptness of the moves has been quite stunning. So I want to have a look at the implications of the size of the move on Thursday night and Friday night, not so much the direction. So just a quick reminder, this is all general advice only. It's information for you to assimilate into your trading plan, and all your trading decisions must be your own. So just a summary of the action for the whole week. The S&P 500 closed down 6.5% for the week, which was one of the worst weeks we've seen in some time. And we're in the final leg down now. There's no question about that. We're in that C leg down, and I'm looking at targets anywhere between 1020 and 1080. But we'll have a closer look at the S&P chart shortly. The Australian market similarly closed down about 6% on the week. It's fairly close to the bottom of the channel that it's been trading in, so a bit of a short-term bounce can be expected from here. Gold was down substantially, down $154, and so that raises the question, is the final leg of the correction in gold that I've been looking for months, is that now complete, or is there a bit more to go? We'll have to wait and see how that pans out over the next couple of days, but certainly it was a pretty abrupt move on Thursday night and Friday night. Silver was, I shouldn't say only down, silver was down by $9.57 or 24% for the week. So a very, very substantial move in silver. And what happens when you get such a big move like that is that it's like hitting someone with a baseball bat. It just stuns them for some time. So I think, as we'll see from the silver chart when I go through that, it's possible we're at a bottom now, but I think if we are, we might just bump around here for a while, because it's going to take the market a little while to get over the severity of what happened on Thursday and Friday night. So let's get over to the charts, and we'll start off with a monthly chart on the S&P 500 index. So this is a very big picture chart. The far left hand side of the chart is 1995. So you're looking at about 16 years of stock market history there. Now, a couple of things that you'll notice. First of all, you'll notice this line at the bottom, which is the RSI indicator, that on a very big picture view, it's a pretty good indicator of really big picture extremes. When it's above 70 and starts to roll over, then, as it was here in early 2000, then generally it marks a fairly significant move down in the market, and the market declined then for the best part of 3 years, 2.5 years, and got down to a point where you can see the RSI was actually below 30%, which again is a point where markets will tend to rally. And so we then rallied for 4 years, from 2003 through to late 2007, until we could see the RSI was again above 70 and overbought. We then declined in the crash in 2008. We got down to well oversold again, and the market was then in a position to rally fairly hard. We almost made it back in the peak of last year, or sorry, the peak of this year, May of this year. Almost made it back to the 70% mark, and has turned over again. Now that doesn't mean that the market must continue down until that RSI gets below 30. That's not how it works. But if the RSI was to get below 30, then you would know that we're probably within a fairly short space of time of a major bottom and therefore a major rally unfolding. Now the line in the sand for me, the ultimate one, is if the market goes below this low here of July 2010. So let me just put a little trend line on that. So that comes in at about 10, 20. It also corresponds to the 50% retracement of this whole move, which started in March of 2009 and completed in May of this year. 50% retracement of that move is also at that same level. So that will be a very strong support level for the market if it gets down that far. If that were to break, then we're looking at lower levels, and things would be getting pretty ugly at that stage. But we're not there at that point. You'll notice that the moving averages are still heading upwards. Yes, the actual market is trading below those moving averages now, but they have not yet rolled over. But this is a monthly chart, very big picture. So let's zero in on something that's more relevant for us, and this is the structure that I've been drawing out now for many weeks, looking for an ABC pattern to the downside to complete this correction. So we saw the A leg, which completed on August 9 at 1101, and you'll notice that 1101 was also exactly the 38.2% retracement of the whole move, the move that started in March of 2009. So that was a very obvious point for the market to stop and start to head back up again. Now it's headed back up in a fairly complex, tricky to read kind of manner, but quite often B legs do look like that. They form more of a kind of a wedge pattern, and now the C leg is definitely underway. Now it's possible that the C leg might have completed on Thursday night. I doubt it, but that's possible. It's possible we could head down to and retest this low at 1100, or we could in fact go a little bit lower down to 1080, which is just a bit of an overrun of this 1100 level, which markets seem to have been doing a lot of lately. Or we could be searching down here into the 1018, let's call it 1020 area. Now, which ones of these tend to pan out will depend a lot on political decisions and announcements in Europe and by the Fed. So I'm just keeping a bit of an open mind at the moment, but I can tell you that we are in a C leg down. It's almost certainly not complete yet. We've got further to go. So therefore, we want to be short selling into any small rallies that we get, and I think the indications are on Friday night in the States that we may have got a bit of a short-term reversal. So we may get a bit of an up for a few days, but I think the C leg still has to play out to the downside. And I wouldn't be surprised if that action occurred through the remainder of September and a good slice of October as well, because they tend to be the weakest months of the year. Okay, let's have a look at our market now. And this is the ASX 200. You can see very clearly there's a big downtrending channel in play. We've got close to the bottom of that channel, but there's no question we're in downtrend. You look at the red 50-day moving average is clearly heading down very strongly. The 150-day has rolled over since around about June. So there's no question we're in downtrend, and we could get some fairly sharp rebounds, but at the moment we're still in downtrend, and that will remain the case until we close above this high here. So we'd really need a close above about 43.50 to signal that this downtrend is finished. So that's the Australian market. Now let's have a look at gold and silver. Now again, this is the chart that I've had drawn out for quite some time. Silver has made a massive move. The last time that it had any sort of correction was back here from March of 2008 down to the bottom in October of 2008. So if we look at that run from 684, we got up to 1920, and you'll notice the last little bit of it, the price went absolutely parabolic. Before that, it was following a pretty reasonable trend line, and it was really only from about May of this year that gold really took off away from the trend line. So if we extend that trend line through, we come up at around about 1450 at the moment. Let's have a look at a couple of the big picture retracement levels. We've got 1438 as a possibility. Hopefully we won't see any of these lower ones. So 1438 is a possible level. And we've also got this last run which started here in July of this year, which started at 1480 and ran all the way to 1920. So a big picture correction was needed. It would have to be some kind of ABC pattern to the downside, and it would more than likely take several months to play out. Here's the A leg, which we got down. It was a fairly sudden one, only lasted 3 or 4 days. We then got a B leg up. It was a bit hard to read because it actually went slightly higher than the previous high. But we're now in the C leg down. Now I've had 2 pathways drawn out. One was a fairly short, shallow C leg. The other one was a more extended C leg down to 1650. Excuse me. Now we basically closed at 1656 on Friday night. So the question is this now complete, or have we got possible further downside down into the 1400 area to either form a double bottom down here or link up with this this long-term trend line? I don't know the answer to that at this stage. I do know, however, that even if gold were to come back all the way to this trend line at 1400 and probably about 1480, maybe 1500 by the time it gets there over the next couple of months, that it doesn't change that uptrend one little bit. You can still see that even if it came back that far, it's still an extremely strong uptrend. So looking at all things considered, there is absolutely no reason in my view to change away from the fact that we're looking at 2,000, 3,000 or possibly even $5,000 gold over the next couple of years, because none of the circumstances that would point to a higher gold price have changed in the slightest. Now let's have a look at the RSI below. Again, with the last time that the RSI on gold got below 30 was basically when the whole move started. So since then we've had plenty of dips, but we haven't yet ever got to a point of being oversold down below 30, and we're still not at this point. So that's why if this does get down, the RSI does get down to be oversold, you'll know that we're not too far away from a major turning point in gold. So we'll just have to wait and see. I think there's a bit, certainly what I don't think will happen is that gold will just turn on a dime and go straight back up again. I don't see that happening. The falls of the last couple of days have been too abrupt for that to occur, so I think we might see a little bit of consolidation for a bit, so there's probably no rush to be jumping back into gold at the moment. But it's a day-by-day proposition. Now the next one is silver. And silver really got hit hard. It's always more volatile than gold, but it really did get hit hard on Thursday and Friday night. You can see the dimension of the fall. Wednesday night we were trading at $40, and we dipped to $30 on Friday night. Quite extraordinary. Now you'll notice that the RSI is way oversold. And I just want to take you back and just point out a few things with respect to this oversold level of silver. So let's just go through and look at every time silver was significantly oversold. So at that point we were basically at a low point for silver. We were down around about $6 and it then ran up to about $16. We then got another little correction in silver. We got oversold again on the RSI, and that was exactly the turning point. And silver then ran from about $9 to about $22. And along the way there was another little point where silver was oversold, and again that was the low point precisely, and it ran from 12 up to 20. Let's come along to here. I'll just tighten in on this one a little bit. Let's come along to here. The next time it was oversold, we got a little bounce, not much, and then it went down again. But if you got in at that point, then after the market moved up a little bit, you could have raised your exit and probably got out around about break even. Now again, here's an oversold point. It was the short-term bottom in the market. The market jumped, and again jumped far enough so that you would have raised your exit at least to your entry. So there would have been a couple of false starts there, but they shouldn't have resulted in any losses. The next time we got oversold was down here when silver was trading at about $15, and that started a massive run that ended up at $50. And now we're way oversold again. Now, looking at the bigger picture, this was the start of the run which occurred in August of 2010. So if we look at our retracement structure from that starting point to the top, we see that the 61.8% level was 29.78. Now on Friday night we reached a low of 29.84. So from that point of view, and we also line up with a couple of low points here as well, or a couple of previous highs. So we've hit the 61.8% virtually bang on. There it is right there. So on that score, you could argue that silver is a buy from here, and it could well see a short-term pop. But in my experience, when we get very abrupt moves like this, it takes a while to play out. Let's have a look at the last time that silver made such an abrupt move, and this was here in May of this year when margins were tightened and silver dropped from the mid $40, dropped down to 33 pretty abruptly. So we had 2 huge days down. We then got a 3-day rally up, and then we just deteriorated into a lengthy sideways move that lasted from May until about July. So lasted about 2.5 months. And that's fairly typical of markets after there's been a very abrupt fall. It just takes a while for them to catch their breath and build momentum again. So I think it's quite likely that we'll see a little short-term rally in silver, probably not more than a few days, but I don't see enough upside to warrant adding to our silver positions at this stage. But that point is coming, and I can tell you that my view of silver at $100 plus remains unchanged. I think we've got massive upside coming in both silver and gold, and it's just really a matter of how we enter. Now, when markets are as volatile as they are right now, the only course of action you've really got is what we've really been doing for the last 4 to 6 weeks, and that's just progressively nibbling away, buying little bits. These markets are too volatile to be taking big bets and hoping that you've picked the turning point correctly. So that's what I've been doing over recent weeks is just nibbling away with gold and silver and with gold producers, and I've said all along that you might have to put up with a bit of short-term downside, but we're doing that with short positions, and we've left the door open to add to them. So no change to the overall strategy. The events of the last couple of days changed the time frame a little bit, but that's okay. It just means we've just got to wait a little longer on some of these moves unfolding. So that's it for this weekly update. So still looking at the overall strategy being to short sell into some stocks because I think we've got more downside yet. Probably just going to hold our fire in the moment for adding any gold stocks or any more gold and silver exposure. So the focus in the short term is really looking to build up some short side exposure. So that's it for this week. Talk again next weekend. Cheers.